Hello everyone, how's it going? In this video, we will talk about the First Republic Bank, trading under the ticker symbol FRC on the NYSE. There has been a massive amount of interest and worries around the stock, and people are wondering whether they should buy or sell this equity, and if they want to do it for the short-term speculation or long-term investment. I'm going to share my views on the matter and to hopefully help you make a better decision for your trades. Before today's video begins, if you like my content, please consider to like, comment, and subscribe to my channel for more analysis. Also, if you wish to support my channel, please consider to use the services down in the description by clicking on the affiliated links. For the Amazon link, please bookmark it so that every time you make a purchase of anything, a commission would be paid to me without extra cost for you. With all that being said, let's jump into today's topic. So recently, the share price of the First Republic Bank continued its tumbling down as a reaction of the market's worries and of a potential bank run that is currently in motion. The share price went down by more than 15% in Wednesday's trading session, and the tendency is not currently slowing down either. At least, we haven't seen a region that can provide firm support to the bank's equity just yet. Over the course of a week, the share price went down by 34%, and it went from around $20 to $13.33. And over the course of the past month, its share price went down by 90%, going from around $120 down to above $13. This movement is certainly significant but not necessarily over the top, given what we know about the state of the world's economy. What we need to see now is whether First Republic can manage to find a support zone soon and to climb back from there. To a point, we can say that there is a bottom around $13 or $12.50. But so far, it has been only able to hold once, so we still have to see whether the future can give us more encouragement and support, and whether this episode can be behind us in the short term. If the whole thing has to carry on for longer, like a year or two, then it's possible that people's interest and patience may be worn out. With that being said, FRC is currently very volatile, and there is a relevance in either having a position or in examining the share price to spot a good entry point. Because of this volatility, if your entry point is low enough, we might be able to profit from the situation regardless of what FRC is gonna do. So this is where I think the stock is kind of interesting in the sense that given that it has already tumbled so much lower, how much lower can it really keep going? So that is the question that we gotta keep in mind while we consider whether we want to buy its shares. And personally, I would say that the probability of the stock going up is actually much higher than it going down. First Republic Bank, also known as FRC, is a commercial bank based in San Francisco. It provides commercial banking and wealth management services to high net worth individuals. It was created back in 1985, has a team of around 7,000 professionals around normal circumstances, and has been well respected in the sector. In 2007, it was acquired first by Merrill Lynch for about $1.8 billion before Merrill Lynch itself was purchased by the Bank of America. The shareholders then changed hands to other investors for almost half the price in 2010. The difference was then injected by the new shareholders in order to meet the regulatory requirements regarding capital levels. Recently, the bank was reported to have a relatively high proportion of its deposits being uninsured, with a large chunk of money that has been lent without the equivalent in the form of deposit. Those concerns, in an era of high instability in the world that has led many of its depositors to start pulling out their cash. And ultimately, the reason why this kind of situation can unnerve the market is because what is at stake here is not one bad year, is not, the loss of a significant tool. It is the trust that people have in their own money, or in their tendency of calling in a loan to the bank. Because yes, the deposit to the bank is a debt. They usually keep a certain ratio of the deposits in the accounts to prepare for any sort of usual withdrawals. If the amount becomes too large at one specific moment, then the bank may get into cash flow issues and the sparkle a bank run that can contaminate the rest of the sector. In those kinds of circumstances, people will often start looking at the weakest elements in the sector and to start to position their chips in reaction to the macroeconomics. First Republic Bank is one of those cases with a relatively weak balance sheet to weather the storm. It has been entangled into the self-fulfilling spiral to the ground once the worries have initiated a massive capital drain as worried depositors continue to drain their cash from this bank to another one, or maybe just keep it to themselves. In order to have a clear look at whether the situation can be resolved, there are a few factors that are critical into influencing what's going to happen next. First of all, will the interest rate continue to go higher up? In this new era of post-QE and increasing inflation, for the moment the Fed is emitting signals that they are getting hesitant in having high interest rates, but these signs are uncertain and far too subtle for any of us to believe it. The market currently believes that the interest may peak at some point in 2023 at the earliest, and the situation of high interest rate may last for a few years. Let's remember that most people don't have enough money to worry about whether their stocks will lose value because the capital flight from equities to safer instruments is really hurting them. Because at the end of the day, those people simply don't have big enough portfolios to really care about that. On the other hand, they will have to care and worry about the inflation because this causes their monthly grocery to be at least 30% more expensive in many areas of the world and going from just barely making the ends meet to having to choose between heating the home, sending their kids to school, or buying food. So this is because those concerns that the central banks around the world have been trying to tackle the inflation, this will have a direct impact on the demand for equities, at least in the foreseeable future. The other aspect to look for is how long can the world pretend that everything is going to go all right with a war going on between major oil and gas exporters and food exporters, which will cause the basic commodities to raise in price significantly. Basically, that is the beginning of the inflation, and if the situation continues to be in a kind of lock-in situation, then the flow of money will continue to be restricted, so that the cost of living for the vast majority of the global population would remain under various degrees of control. One final aspect to consider is whether the financial industry is willing to save this ailing institution in order to uplift the market's faith in the banking industry. So far, this aspect seems challenging to reach, because the looming recession has already scared off large amounts of potential investors. If the market is offering guaranteed returns on what used to be junk bond returns, then the amount of risk-taking can be limited, right? It can be tamed. Furthermore, let's remember that back then, Lehman Brothers was trying to get itself saved by its peers without any significant progress. So things may turn out differently for the First Republic Bank this time. And if the company manages to survive this episode, and this is a big if, obviously, then its capacity to go higher in the month to come is more than possible, much like what happened to something like AIG back then. So AIG was priced in either close to 1,000 or in multiple hundreds of dollars. And then from one day to another, it tumbled down to $10 or something. Something that's really low. And then over the course of the next few years, it went back, slowly but surely. I say slowly, but over the course of a year, it's still like above, 20% of increase or something of that kind of magnitude. So it's still worth it to keep an eye on FRC. If you think that its going concern is no longer under threat, then I would say that the short-term speculation is for sure a viable option, and even the long-term might be a good choice if you trust that this company can weather the storm. If you're not sure, if you lack the absolute faith in this company's capacity to go through this current difficulty, then I would say that maybe best stick to short-term trading instead of long-term holding of FRC, because in a way you're right. Like I cannot pretend that we are for sure going to come out of this winning. I cannot guarantee that FRC has to find a party which is willing to lend it money, And I'm also not sure that FRC is going to weather the storm over the course of the next 2 to 3 years. So with all these being said, I would say that it's a volatile position that is worth looking in. It doesn't mean that you absolutely have like a possibility to make money beyond, I would say, 60% of the probabilities. So overall, I would say that yes, it can be a position to contemplate with. I would say that maybe for a start, have like 0.5% of the portfolio in now, and then the next 0.5%, save it for like the next month or two, assuming that the situation either has improved or didn't degrade significantly. My recommendation for FRC is to wait for the price to be able to stabilize above a certain level for at least a week, and then buy in for the short-term trading. The risk involved in this case is huge, so we should expect at least 50 to 60% of return for this position. The maximum exposure I would also recommend is around 1% of your portfolio.